everyone. This is Abhijit Chatterjee recording a weekly session for Chartsarefun. This is for the week of June 2nd, recording this on Saturday, June 7th, Saturday afternoon. Well, this was a very interesting week. Market climbed higher highs. It's been a wall of worry, as many say. Market psychologically closed at 6,000. We know that the peak on February 19th was at 6,147. We're not too far from there, maybe within 2 to 2.5%. We're there and we'll get there. And while the bears are saying that the market looks ready for a sharp correction, many are even looking for a retest of the April 7th low at 48.35. TomLee continues to be bullish. So TomLee is expecting a face ripper rally ahead. He's calling it the most hated V-shaped recovery. So the first half of today's session, we're going to walk through the bearish side of the arguments. What are the bears talking about? Even Barron had an article this weekend saying, watch out, S&P at 6,000, be careful for the buyers coming into the market. And then, so the first half will be showing some arguments of where the bears think are concerning. And then the second half will be TomLee's bullish argument, see where the signals called the tea leaves of the market from what the prices are telling us. We'll start off with the small cap, the IWM ETF. We will look at S&P 500 from a very shorter term hourly chart to a longer term daily and weekly, and sum it up. And in our opinion, next week, there is two key events. There is on Monday. So we know that President Trump and President Xi met on Thursday. It was a phone call. It was a fairly positive phone call. And as a result of that, the US and the Chinese senior officials will be in London meeting on Monday. So we'll see what comes out of that. That could have some positive impact to the market. And then there is also CPI. We know that the Fed closely watches that. CPI data comes out next week. So we'll look at the CPI trends and see what CPI could be printing. And then the week after, on June 18th, the Wednesday, the June 18th is when FOMC comes up with their next Fed rate decision. No one expects any cuts into June. The earliest is perhaps July, but market will be watching their indicators of what their thoughts on the economy is and so on. So they will kind of take some leads from what Chair Powell talks about in the presser after the Fed conference next week. And the week after, I mean, the week of on the June 18th. So with that, this is our website, our blog site. It's in Substack. I appreciate you subscribing to it. It's free. Just share your email and you'll get the blogs when they're published. We have our YouTube site, also called Chartsarefun. This is, published every week, usually on Saturdays or Sundays. We appreciate you, if you like the videos, to hit the like button and subscribing to our channel. I said I'm going to start off with the bearish side of the ledger. Here is Barron's. S&P finally hit 6,000, buyers beware. So that's Barron's caution. They didn't put any bear signs. So they are in some ways cautiously optimistic, you could call it. But at least they're quoting a New York Stock Exchange trader, strategist, and says that there are indicators that says the market might have come too far too fast. And by too far too fast, we're talking about S&P climbing from 48.35 to 6,000. That's a 24% move. So in many terms, bears are becoming emboldened. They feel that market could kind of pull back from here. Now, a key indicator of the smarter money is the bond market, and this is the TNX, or the 10-year Treasury yield. And we see in reaction to the jobs data, we know that the May non-farm payroll data came out. Started off with the ADP coming out earlier in the week on Wednesday. That was fairly poor, but the non-farm payroll actually surprised the market. Market was expecting 125,000 jobs to be added in May. It added 139. So bond market didn't quite take it well, thinking that this indicates a reasonably resilient economy, no need for Fed to do any cuts. And as a result, we can see that the 10-year yield went up almost 11 basis points. It closed near 4.51. Starting off from near 4.4. So that's 11 basis points. So it's above the key psychological level of 4.5. We can see this chart here with the MACD climbing higher highs, RSI climbing higher highs. And the bears on the bond market, which in this case looking for higher yields, will look at this and they say, you know what, this is poised for a breakout of the yields above the key 4.62 level or 4.63% level. And that measured breakout, if it does come from near 39, 3.88 is almost near 3.9 to a 4.6. You're talking about 70 basis points. Add that to 4.6, you're talking about a 5.3 handle, 5.3 or higher. That's what the bears would look at. They would look at 10-year yield to climb, and that would mean market would not like higher yields, and they would expect the market to take a beating. Now, that's the 10-year yield. Let's look at the next chart of the non-farm payroll report coming in once every month. And this is showing us that as high as over 700,000 jobs were added in the 2022. From there, we know the market has slowed down. The economy has slowed down a lot. Rates have gone up, and that is now trending lower. So while, yes, it beat expectations, just look at this end of last year, even as much as in December, we had number near 307,000 jobs were added. And then from there, we are steadily coming down. Yes, we briefly went up from February into March, but then the last consecutive months, the trend is lower. Unemployment is 4.2. So that's been steady the last 3 months. So bulls would say, no, that is steady economy doing well. But remember, Fed's two mandates are inflation and the job market. So in particular, they're watching unemployment may not be a concern, but there were many economists on the press yesterday saying that, look, participation rate went down. Fewer people are actually looking or applying for jobs. Part of it is the immigration policies. Many have left the country, and that participation rate coming down is why the unemployment rate is artificially subdued. If you use the right way of calculating it, they feel unemployment is actually shot up from 4.2 to 4.7 already, and down the line it'll get adjusted, and we'll start seeing later in the year an increasing in unemployment. And we know that when recession comes, when economy slows down, unemployment starts going higher towards the 6%. But at 4.23 consecutive months, bulls seem to be confident that this is positive for the economy. That said, the trend is key from 185,000 jobs to 139. That's a declining trend. So we'll see what the next few months bring for the job market. The other key factor that the Fed is watching is, of course, they have their own PCE indicator, but the consumer inflation, the CPI, we know that with the tariffs, Walmart has already indicated in their first quarter earnings that they do plan to pass on price increases to their consumer. And remember, Walmart is king of price. People go to Walmart because that's the best price you can get on their retail products. But if the price sensitive retailers warning that they could be hiking prices, passing on higher prices from the tariffs onto their consumers, that's not a good indicator for inflation moving ahead. And that's where you got many economists warning of stagflation, where the economy will be stagnant to a recession, GDP will come down, and inflation will kick higher, which is the worst of the two scenarios. GDP lower, economy slowing down with higher inflation means it stretches or hurts the purse of consumers. Inflation staying high means Fed is not able to bring rates lower, and that means more money to borrow, means less money available for the consumers to spend on discretionary items. And as a result, it's the economy overall. And we know that the US economy has a significant percentage, over 60% consumer tilted, consumer spending, and all that impacts the US economy and the GDP. So this has a steadily declining CPI. We know that it hit over almost like, in this particular case, hit almost 9%. What we are showing here is the rate of change in a monthly chart, so year over year CPI, and we can see that it has come down towards a level that is right now near almost the 2.33%. We can see that's the 2.33% that it's at right now. But it's come down a lot. But if you look at what changes CPI, a big, and this is CPI, not core, remember, so food and energy is included in it, is oil prices. Oil prices play a big role in CPI. And guess what has happened to oil prices in the recent month of May into June? from a 60 handle near the $60 per barrel, it is now steadily climbing and above the 70 key level at 71. If you look at a technical analysis, 60 to 70, kind of an ascending triangle there, higher lows, higher highs, breaking above the 70, that measures above 80. So if you got a climb of oil prices above $80 a barrel into the next couple of months into summer, we know that summer tends to see higher oil prices. That would mean inflation could start ticking higher. So bears are pointing to inflation ticking higher. They are pointing to employment not doing so well, which means the economy is slowing down. And bears are effectively not expecting the Fed to cut rates, even though there's a dual mandate. Employment may slow down, but the unemployment is at 4.2. So they would say, well, there's no need for Fed to act right away with unemployment holding steady at 4.2, and they call it almost near full employment. And they say that inflation taking higher means Fed has no reason. Some even feel that there's no reason to do any cuts this year. Now, if you look at volatility of the market, which is really the options market in terms of put call buying and so on, there is this higher low pattern, right? 12.7 was what we saw in December, in the 14s in the January-February timeframe, from where we spiked to 60 on April 7th, came down, and we were hovering in the 17s till yesterday. And that's when it broke the 17 level to a lower low. The low on February and March, by the way, after the February climb coming back down, it was at 16.97. We've broken the lows of March now at 16.77, so almost 20.2 below the 16.97. It even touched 16.65 intraday on Friday. That declining trend in VIX is actually bullish, but bears are saying that overall the trend is higher lows. It may not go to the 14s and the 12s anymore, and from here we could see another VIX spike. So that's the thing that the bears are cautioning. Also, they're cautioning market cycles in terms of a summation index, which is a broad New York Stock Exchange market breadth indicator. It does cycle between minus 1100, which is rare. You get that in bear market lows, and we know that the bear market low of 2022 was in October. That's where we got the minus 1100. The plus 1100 does repeat in a bull cycle every few months. So we see that we got a plus 1100 back very sharply in a span of 4 months in the February timeframe. Then it pulled back to a higher low at minus 834, higher above the minus 1100, because now we are in a bull run. And it went back towards the 1100 towards in a span of 2 months towards late 23, pull back to a much lower low at like a higher low at 135, back to the 1100. So 1100 has been tested thrice in this bull run. And we believe that this is from a higher low, from minus 1100, minus 834, and the very recent April low at minus 590. We expect this is climbing back to the 1100. So we are overall bullish inclined. We feel there's more upside in the market. Until the summation index gets to the 1100, we would feel that there's more upside in the market. But the bears are saying, look, the summation index has started declining. It has topped out at a lower high from the 1100. It's already topped out below 700, and they're expecting this to start coming down. It's possible, bears could be right here, but I see this more of a climb that we saw in the July through the October timeframe. See how it climbed, declined for a short period, then climbed again, declined for a short period, and climbed again. I see that as stair-step climb going on. I think these 3 weeks that we got, this is a weekly chart, was a decline. We should start resumption of a climb next week. I think there's possibly a potentially good Chinese US negotiation coming out of London next week, and potentially that's what I'm thinking. We might get a climb back off the summation index while the S&P climbs. Now, the other bearish argument is look at the advanced decline line. This is also New York Stock Exchange's advanced decline line called NYAD, but in this particular case, doing the 30-day moving average of that shown in blue. That is also an intermediate market cycle indicator. It goes between plus 400 to the minus 400. The scale to that is on the right-hand side. The scale for the black line, zigzag line, is S&P 500, is on the left-hand side. So S&P 500, as we know, when the market breadth declines, and we can see it here in 2022 from August through the October. As the market breadth declined, S&P declined. As the market breadth declined in 2023 from February through March, we can see that the S&P declined. Here, the market breadth decline, we can see the S&P decline. So we've seen in the past a correlation of market breadth decline indicating S&P's correction or S&P's decline. That said, look how things diverged in the 2024 timeframe. We did get a pullback in the market breadth from late 2023, from December 2023 into the first couple of months. And as that decline happened, S&P took off. It did not. It had a like a brief pullback. We can see a brief pullback in December, but that was it. It climbed higher highs. And as it climbed higher highs, the market breadth stayed range bound. It did not go up or down much, but it stayed range bound in the little above the minus 200 to the plus 200. It would touch the 400 once in a while, but then pull back and stayed in a range bound fashion. From there, the pullback that we just got this year did see the market breadth decline towards the minus 400 as we got the sharp waterfall decline of S&P from near the 61.47 down to the 48.35. A V-shaped climb coming on, market breadth improved. In fact, it had a higher high in blue on the market breadth 30-day moving average above what we saw in the beginning of 2025. That's a bullish indicator. The fact that the market breadth climbed a higher high while we got the V-shaped climb indicates that this is a bull market. And that takes us to TomLee's statement that he expects this most hated rally ever to actually have a face ripper surge and continue its climb. Now, one indicator of a bullish sentiment or a bullish price tea leaves is the small cap ETF called IWM. What we see here is a picture perfect inverse head and shoulder pattern. The neckline is at the horizontal level of 210. That was a resistance level. A left shoulder at 196, a head at 171. Test of that neckline at 210. Pull back to a higher low. When the right shoulder is higher than the left shoulder, that's a very bullish indicator. So it was 3 points higher. 196 versus 199 is the right shoulder. And guess what happened on Friday with the strong jobs data? The bulls rejoiced. They gapped the IWM higher and broke above the key 210 level. 210.13 was the previous high. Guess where was the low of that candle for Friday? 210.60. So it jumped over the high, the resistance level of 210.13. The low was 210.60, climbed up as high as 212, closed very near 212. This indicates a breakout. Now, we would love to have had seen more volume, because when you get an inverse head and shoulder volume followed with, when you get an inverse head and shoulder breakout followed with a strong volume on the breakout, that's a confirmation of the breakout. Unfortunately, volume was actually a little lower than the previous day on Thursday, but we hope that if any bullish data coming out on the tariff front on the US-China talks on London on Monday, and maybe CPI yet again lowers and provides a bullish number, we could see a continued climb in IWM. Near term, where do you think IWM can climb? Yes, we can see a 200-day moving average flatlining, declining to some extent, flatlining at 215. We feel that would be a strong resistance. Before that, the 213.49, we can see it tested twice here in October of 2024, and then as recent as January of 2025. 213.49 or 213.5 is a resistance level. So we'll see it fight that, having taken out the 210 at 213 and then up towards the 215. So we shall see what IWM does, but near term we expect, now the fact that it is broken out, a test of 215 coming in the very near future. We can see RSI has begun to climb, about to take out a higher high. That's bullish. We can see that the MACD was flatlining at the zero line, but from there went positive on Friday. The MACD can now climb and take out a higher high. That indicates bullish strength in small caps. And bullish strength in small caps means more broader rally, more stocks participating than just the magnificent 7 stocks that move S&P 500 a lot. It means broader participation, bigger movement in the rest of the stocks, and that means it's bullish for the overall stock market. Now, this is S&P 500 on the hourly chart. a beautiful cup and handle. We can see 59.68, pull back to 57.67. It didn't go back and close the gap. We can see there was a gap left from May 12th. That's when the first China news came in after the Geneva conference. Geneva conference happened over the weekend. On 12th, President Trump came and said, we are putting a 90-day pause on China tariffs increases. And as a result, that 100 there was a number closer to 145%, came back down towards the 30%, which they had before the trade wars had started. So that kind of pause helped the market gap higher, and that gap has not been closed. Came back and kind of took the top of the gap at 57.67, has been climbing higher highs. This is a beautiful cup and handle. So 57.67 to 59.99, you're talking about 232 points. Add 232 points to 59.99, that's 62.31. That's above the 61.47 level. So that's where we think potentially S&P 500 is headed. Yes, we have to see what the some of the indicators are telling us, and these are market breadth or oscillators giving us overall advanced decline, measurement of market movement, and this oscillator looks poised to climb higher. We can see that the MACD histogram has carved out a beautiful bell shape below the center zero line and now about to climb higher. So at the MACD histogram climbing higher, the blue region from below the zero to above the zero to have another nice bell shape for the next few days, for the next 5 to 10 days, we can see this climb continue. We expect the oscillator to climb, and with that, we expect the S&P to climb. So also the bullish percent, this is based on point and figure charts. The bullish percent index climbing higher means there is more market participation, newer bullish charts showing up in the S&P 500. The bullish percent had a shallow pullback from 76% to 68%. And the last week, it has been climbing back towards the 71.8. We expect this to climb. We see the MACD histogram of this also printing out a beautiful bell shape below the zero line. So we expect the next couple of weeks to be very bullish. Maybe it continues till the FOMC meeting. We know that Chair Powell overall is extremely concerned about inflation. He's going to be very cautious and so on. So that may dampen the move. But till the June of 18th, we still got 8 solid market days in that. In the 8 solid market days, we could have a move and achieve that S&P 500 move that we're expecting towards that 62.31 level. Join the highs from December. Higher highs, right? 6,099, 6128, 6142. If it goes, join that high, if it goes and meets that trend line of higher highs, that's around the 6,200 plus level is where we think S&P is headed. From there, we do expect a pullback. Maybe after Chair Powell's FOMC meeting, he putting out his hawkish stance again, not making any commitments on interest rate, increases, market getting worried about the July 9th deadline. Remember from April 9th, that put a 90-day pause, which means that kind of comes due in July 9th. So worry about what President Trump and his administration is going to do by July 9th, market may have a pullback. We don't expect a deep pullback. We have no expectation of a retest of that 48.35 low. We expect a pullback perhaps to test that 57.73, 5800. In fact, we can see that the 57 200 moving average is 57.96 in red. That's climbing now. The 200-day moving average is climbing. The 50 days now crossed below and has started climbing. We expect this to have a bullish cross, the golden cross, in the next several months. We expect this to be a shallow pullback and a massive breakout higher. If this turns out to be a true inverse head and shoulder from a 48 level to a 62 handle, you're talking about roughly 1,400 points of S&P added to 6,200 is 7,600. That's a mega bull run expected into this year, into 2026. So bulls could have an amazing climb if this all pans out as the charts are telling us. Now, if you look at the weekly chart of S&P, what do we see? Accumulation distribution line on the weekly chart. First of all, this is a classic V, right? This was another classic V that we got in 2023. We got a pullback to test the 50-week moving average, move slightly below it, and then a classic V climbing higher highs. This broadly, from Elliott wave, from the way the patterns are, is going to be the fourth wave having completed from 61.47. These are the fourth intermediate term cycle from 61.47 to 48.35. We are on that fifth wave climb, and the fifth wave climb from 48 to 76 cannot be ruled out. That's definitely a potential move. So 48 to 76, we're talking about 2,800 points, and that's a possibility of where S&P could be headed. As much as bears would say, look, there is negative divergence. The RSI is at lower highs. We agree. The negative divergence is what we caught that sharp pullback into 2025. That has since been reset. We got RSI coming in testing 30 from there, sharply moving higher. RSI now is on a new climb, on a new cycle. This is the new fifth cycle, and we expect RSI to climb back higher highs. We expect MACD is only climbed for 3 weeks. We can see that above the zero line, and the black line is steadily climbing, so is the red line. That MACD has got more to climb higher. And the key, more than MACD and RSI, is the signal of accumulation distribution. Guess what that's been doing since the late March level? It's been climbing higher highs below, above what we saw in the beginning of the year. Means AD is an indicator of accumulation, smart money buying in. So smart money, as much as they're bearish out on CNBC and the press and so on, it's got a beautiful play of this. They are betting on the market to go a lot higher, a beautiful gap up. This was also a very bullish move above that 5,700. That gap up stays unfilled, is from the way we see it, and we continue to climb. And towards the 7,600 is where we see S&Ps potentially out of this beautiful inverse head and shoulder. To sum it up, the bears are, as Barron and others, claiming that the bulls should be careful. We're not saying they should not be careful. We do believe that in a couple of weeks, we do get a pullback, and we are showing that here in that pullback, that right shoulder pullback. So yes, they may have a point. They are talking about 10-year yield climbing. They are talking about CPI potentially because of oil prices beginning to have a little bit of an upward slant higher. They're talking about volatility coming down to complacent levels. Higher lows may not go to the 14s, may start climbing higher. So there could be a VIX spike is what they're saying. And they're also saying that, look, the summation index has started declining, and that could keep declining, which we disagree. We don't think it's going to decline back to the negative levels. We think it's going to be a higher low, and then from there climb higher highs towards 1100s where we see that happen. And they're talking about market breadth. The advanced decline line beginning to weaken as the S&P climbed a higher high. Look in blue, it is now at a lower low. So they're saying that, look, breadth has started declining, a new intermediate cycle is downwards has begun. So from plus 400, it'll go to the minus 400 over the next couple of months. We're not denying that's a possibility. We think if you're going to get that right shoulder pullback, we are likely going to see negative values in this advanced decline line. But that doesn't mean that we have seen in the past where the advanced decline line can decline, but the market can go higher. This was the best example. Advanced decline line coming down, but the market climbing is what we think is possible going to happen. So TomLee is, of course, extremely bullish, talking about phase tripper surge. We believe that, yes, if you're seeing when so many people are bearish, move from 6,000 to 6,200, that's a span of 200 points happening in the next 8 days. That's a phase tripper surge, a very sharp move in a span of just 8 days. We expect a 200-point move in S&P possible. We expect small caps to be bullish, a nice, beautiful breakout with a gap happened above 210. We expect this to climb up to 248, but not in a straight line. We do expect near term to hit resistance at its 200 near 215 on the IWM, maybe a little higher, but between 213 to 215, we expect it to hit some resistance, pull back, maybe close out this gap just below 210, and then from climb higher towards the 248 is where we see small caps headed in the span of the next few months. And good luck investing. We'll talk to you next week. Thank you.